Hi, everyone. Good afternoon or morning, depending on where you are. Thank you for joining us for this will be sort of an educational series. A lot of our webinars, we present actual opportunities and or platforms that some of our customers have used. But this time we wanted to take a step back and we entitled this presentation actually just Self-Directed IRAs 101. So we welcome you joining us. Brendan Walsh is here kind of manning the back end of the webinar. We'll be kind of monitoring any questions in chat, so we welcome those. And we do have some audience poll questions as well. My name is Henry Yoshida. I'm the CEO and co-founder of Rocket Dollar, and we are broadcasting here from Austin, Texas, where it is still almost, from a heat index standpoint, 100 degrees. And for those of you that are new to our organization directly, we are what they call self-directed IRA company. So that's a organization where we provide a technology web-based platform that allows individuals to open IRA accounts, keep the same tax benefits, but instead of public investments such as stocks, bonds, and mutual funds, our customers are able to make private and alternative investments using their IRA accounts. So just for me, CEO, co-founder of the company, I've been a CFP since the year 2004. Pretty much spent my entire career in the tax advantage and retirement account space. And just I really, when starting Rocket Dollar, saw a tremendous growth opportunity for individuals who wanted to basically unlock IRAs, 401ks, as I mentioned, keep the tax benefits, but make private and alternative investments, is just because that's become so much more of an available investment stream for individual investors today in the US. So let me just, without further ado, dive in. And maybe basic for some of you. Either way, it's good information and content to keep. It's always good to get sort of a refresher of what you can and can't do with self-directed IRAs. And for those of you joining us who maybe just need a complete overview from just the foundation of what self-directed IRAs are, I think this would be a great session for you. So time-wise for us, we're going to be on for about just 35-40 minutes, so not too long. We'll let everyone sort of get back to their busy days here on hump day. But without further ado, we're going to start really just right at the beginning. Just what is an IRA account in the first place? So I know that this is a ubiquitous thing now here in the US, but so we'll go quickly here. And Brendan, feel free to interject as well if there's some questions that come in or if there's some color that you want to add as well. So I know you're not on video, but you're the good looking one of the two. So I wanted to make sure I kept the spotlight today. But individual retirement accounts, actually, oddly enough, just became 50 years old here last week. So the original ERISA Act was passed in 1974 in September. So American workers would have a retirement account that was just portable. They're tied to an individual, hence the I stands for IRA, individual retirement account, not a company. And individuals can actually have as many as you need, even if you have a current or old employer 401k plan. So one of the caveats is that you do have to have US-based income for you to be able to contribute to an IRA, but you don't have to have US-based income to have an IRA. And we'll explain a little bit more about how you fund IRA accounts. And just as a refresher too, since we're here in September, maybe you can plan for those over the age of 50. The cash contribution limit is $8,000 if you're over the age of 50, and it's $7,000 for 2024. And these numbers actually have gone up quite a bit over the last 2 years because they are tied to the consumer price index and inflation. So just as a refresher, if you know you're short or haven't made a contribution, this is a great way just to maybe plan between now and year end, or actually your tax filing, that you could sock away a little bit of money and get long-term tax deferrals from that in the form of contributing to an IRA account. So let me go to the next one. But what is the self-directed IRA, the types that Rocket Dollar offers versus an alternatives IRA? So in this case, I'm using self-directed IRA just as an individual retirement account where people have the ability to pick and choose their investments. So an alternatives IRA or self-directed IRA are those that are IRA accounts, but they allow you to invest in assets that just are not publicly traded. So i.e. New York Stock Exchange, NASDAQ type investments. And in our case, most of our customers bring their own deal to the table. So this might be that you have an opportunity to become a limited partner in a private fund. You have an old 401k that you rolled to an IRA and you want to purchase an investment property and so forth. So many different examples, but we actually have some slides that detail exactly what you can and can't invest in an IRA. But what does that really mean? So really, the premise is that since 1974, although it may not be widely known by everyone, that you can actually invest in pretty much any active and or passive investment while avoiding capital gains tax. You can access alternatives that, potentially have higher returns, maybe worse tax treatment. So they just benefit from being inside of a tax deferred account like an IRA because they create a lot of income, or they have potential for very, very high returns. And as long as the investment is legally named in the IRA, you retain the tax benefits. So this is no different than if you own Tesla or Meta, a publicly traded stock, versus owning an investment property or even cryptocurrency as well inside of your IRA. So I'm about to go to the next slide, but Brendan, just feel free to jump in if you have any comments or just something you need to share with the chat as well too. So.
Just one question so far, but it's about accredited investing. And just so you know, you do not need it to be an accredited investor to do a self-directed IRA, but some of these deals may need accredited investor requirements. So as long as you meet those, you can typically meet those as well when you invest with a self-directed IRA.
Yeah, that's a great question. So as a platform, really the requirements to open an IRA are, just that you're an individual and you're probably domiciled in the U.S. To make contributions. You have to have U.S.-based income, but the actual need to be accredited is tied to the investment itself. So oddly enough, it's a large ticket purchase, and the first item on this list of the most popular is real estate. Large ticket item is to buy an investment property, of which many of our customers, a large double-digit percentage of our own customer base here at Rocket Dollar, purchases single-family real estate. You don't need to be accredited, even though the value of that property may be $250,000 or more. Yet, if you wanted to make a $25,000 investment into the second option on this list of private equity deals, so you have a chance to be a friends and family limited partner in a small private equity fund, most likely that structure would require you to be an accredited investor to make that $25,000 investment. So it's not based also on the dollar amount of the investment, but in usually the type of investments. And as you go down the list, this is really just not super comprehensive list, but just a broad example of all the things like crypto, real estate, private equity, precious metals. And so since the list is actually long, and this is actually somewhat truncated, just the most popular, it's more relevant to actually have an understanding of, maybe later we'll explain what you can't do in an IRA. But if I pause right now, so we have questions for you guys as well, just to kind of keep it interactive here, which we encourage. But maybe just you can just type anything and hit enter into the chat box. But have you used a self-directed or alternatives capable IRA? So obviously just like a yes, no. So
one gonna get that ready real quick, Henry. I'll just get the poll ready.
Yeah, or people, if you don't want to spend the time, Brendan, people could just actually just kind of type yes, no, no, stuff like that. Just make it easy for them too. It's just to get a general sense. But since this is a virtual webinar, get a chance to see hands raised and get a sense of maybe where to go deep, where to stay high level and so forth. So that makes sense. But let me kind of, as I mentioned, what other than stocks and bonds can my IRA not access? So this is even from the beginning of ERISA, that since the list and definition of actual active and passive investments in an IRA is not itself restricted, they actually came up with a list of the things that they codified in the code, what you cannot invest in. So S corporation investments, insurance, specifically life insurance, you can't own inside of a IRA account, and then collectibles, which we kind of define, so you have an understanding of what those are. So that can be anything from artwork in the form of direct ownership, baseball cards, classic cars, collectibles, basically. Oh, there, the thing popped up right now. But anyway, so that type of collectibles is what we're referring to now, that you can't own inside. But the caveat here, and this is just a real quick aside, and maybe the more advanced ones for people who are experienced in self-directed IRAs, that you can actually invest in digital platforms that securitize a fractional ownership of possibly one of these collectible items. So you need to check. It just depends on how they have it registered. But if the investment is registered as an actual investment with the Securities and Exchange Commission, then although the basis of that investment might be a collectible itself, you, in a lot of cases, would be able to invest in it because you're purchasing an investment unit that represents a part of that collectible. So that's something that I would highly encourage you to kind of look into a little, if that's the interest that in the type of investment you want to do in your self-directed IRA. But you can also reach out to our team. And our number, if you still look at the letters on the phone, it's just pretty simple. It's 1-855 Rocket D. So that's our phone number, but we'll have that here at the end on the last slide as well.
And about a little over half, Henry, is brand new to self-directed investing in the pool here.
Okay, good. So people that don't have accounts yet, so maybe you're looking into this. This would be great because this information will be available afterwards, and really we're just trying to take like a probably like very complicated concept of what you can and can't do, but just distill it down into like 20 slides, so you have like a good rule of thumb, something you can share with your friends, maybe your tax advisors, maybe the potential investments you're interested in doing. But the different types of IRAs. So remember, an alternatives IRA or self-directed IRA is no different. It is a form of an IRA. So that means that they're available in all the same formats that you're used to with your regular accounts at traditional brokerage houses or with your financial advisors. So the most common, of course, are traditional and Roth. And I think, maybe since half are just new, the easiest way for me to explain traditional Roth is that traditional, you put you get a tax deduction for the money that you put in the year you make that contribution, and then your money grows. But then when you take money out, then you'll be subject to paying taxes on the amount over your principal. In the Roth, think that you can pay tax today. So let's say you make a contribution of $7,000. That $7,000 from 2024 contribution over the next 25 years grows to $21,000. So it triples in value. Then, since you paid tax on the $7,000 contribution in 2024, thanks to the late Senator Roth of Delaware, you would not be due to pay taxes on the additional $14,000 gain because you paid it today. So it's just pay tax tomorrow or pay tax today. That's the difference between traditional and Roth. And then the less common ones, these kind of relate more to situational type IRAs is what I call them, and or a small business IRA. So SEP IRA is for an independent business owner. In most cases, are very small business, so 100 employees or less. Inherited is that you are the beneficiary on an IRA for someone who's deceased, someone who became deceased, and then now you're the owner of this IRA that used to belong to an individual who's since passed away. And same thing on the minor side, it's just the flip side that you can open an account, custodial IRA account for a minor individual, and they still have to have earned income. But you are able to open an account. We have people that are opening Roth IRAs for individuals under the age of 18, children, obviously in most cases, and they just kind of match like maybe what that part-time income is, just to help them get a head start on a long-term, non-taxable retirement account vehicle. So all IRAs have in common, whether they're alternatives IRAs or traditional IRAs from brokerage houses of types that I mentioned earlier, from your financial advisors and brokerage houses. There's no capital gains tax. They have the ability to have tax deferrals, and they are not a brokerage account specifically. So like if you see a brokerage account, that specifically dictates or indicates that it's a taxable account and so forth. So I know a little bit like going back to the basics, but probably a good refresher for the half that might be new to alternatives and are wondering like, are they super different from the regular IRA accounts that I have now with my financial advisor? So I'll go to the next slide, and Brendan, just feel free to jump in if there's anything as well.
We had someone that wants to go over distributions. I'm sure we'll get it. And a lot of times they say, hey, we often focus mostly on contributions. So when we're mentioning contributions, I guess we can try and work in some distribution knowledge as well.
Okay, let me make a note here on my notepad, and I'll get to that as well. So, the types of IRAs that people use most often, I mentioned, are traditionals, and the way that they can be funded. To be real frank, most of the large contributions, because when I say $7,000 is what you can put in today, and that's actually the highest amount that you can contribute if you're under the age of 50, the highest amount you've ever been able to do since 1974. Well, how do some of these people get very large IRA accounts? Well, the large chunky contributions or contributions made to an IRA typically come in the form of a rollover from an old employer 401k. So that's the account you get through your job. You're able to put away $21,000 of your income, and then on top of that you can get the match if your employer offers that, and you contribute to that account for a job you worked at for 10 years, and you might accumulate a balance of $350,000. And when you're no longer employed there, then you do have the option, if you want to increase what you can invest in potentially, whether that's alternatives through a provider like Rocket Dollar, or whether that's publicly traded stocks like Tesla or Meta, platforms at Fidelity or through your financial advisor. you roll over that old 401k into an IRA, and then you have the options to make investments outside of just the maybe 25 fund menu from the old 401k plan. Same tax status that you already have. So if your 401k was funded with pre-tax money, then it would go into a traditional IRA. If you have a more modern 401k plan and you were contributing on the Roth side, you can roll that into a Roth IRA. So it's where most retirement funds are right now. Like people kind of accumulate the large amounts there, then they go to a different job or they retire, and then they want more flexibility or need more flexibility. So they seek out a provider to open an IRA with, and we're one type. The brokerage houses and financial advisors are another type, usually limited to public investments. If you want to make private and alternative investments, open one of those IRAs with a provider like Rocket Dollar or one of our competitors in the self-directed space. So the second most popular account is the Roth IRA. And as I mentioned before, you pay tax today on the amount you contribute. And then that point going forward, you don't have to pay taxes. So it's basically like you're paying tax on a smaller amount today. If you give the account enough time to grow, then you would not have to pay taxes down the road when you make, we'll kind of get to those distributions. So maybe this is a good segue before I get into the next slide, Brendan, just to quickly address that distribution question. So at the end of it, if you take money out of a traditional IRA, you have to meet certain requirements. So one of which is that you're over the age of 59 and a half is the big one. And in a Roth IRA, there's a couple of different provisions as well, but I'll get to that in a second. So you've put money into the account. Either you have not paid any tax on the account because it came from a traditional 401k and was rolled into the IRA, or you've made contributions in the form of cash to the IRA and you took a deduction in that same year. Either way, the growth on that money is subject to taxes if and when you take a distribution from that account, provided you're over the age of 59 and a half. So, hypothetically, you need to understand that if you have a $500,000 traditional IRA and you decide to take a distribution for $50,000 of it that year, you'll be subject to taxes on that $50,000 that you withdraw down the road. So that's how a distribution works in a traditional IRA. The Roth IRA is different because it's accumulated with money that you've already paid tax when you originally made the contribution. So the government says, hey, we got our tax money when you made the contributions throughout the years. Whatever it grows to, you can take your distribution without taxes. So it's basically you're paying taxes today to not pay any taxes tomorrow on what presumably will be over time and good investment choices, a larger amount of money. The one caveat there is that you can't just start a Roth IRA and make distributions right away. It does need to be in place for 5 years. And then again, it also requires you to be over the age of 59 and a half. So those are kind of the high level ones that probably touch on 95% of people's distribution related questions, Brendan. There's little nuances that maybe cover the other 5, but we won't spend time to go into that today. And again, people are welcome to call. Everyone on our team that answers the phones is kind of more than versed just to answer those types of questions, as well as helping you understand the real nuanced differences of our types of IRAs versus others. And we're there to answer those questions during normal business hours on weekdays. So another type of account that we offer is actually a self-directed solo 401k. So this is just a one-person business 401k. So if you have, let's say, a consulting business, if you are a sole proprietor, you can do one of these. So the advantage to this is that same thing, it's alternatives investment capable when it's offered through Rocket Dollar, but you could put significantly higher dollar amounts because now you're operating as the 401k. So your ability to put money in is subject to 401k rules, which allow you to put much larger dollar amounts in the form of salary deferral, in the form of profit sharing and match, and so forth. So again, that number for 2024 is actually upwards of $75,000. And this amount changes if you're over the age of 50. So it's in the high 60s if you're under 50. So just make note of that.
We have 2 things that come up a lot, Henry, I think, is some people ask about SEP IRAs, which we also can provide, but the solo 401k is very similar to a SEP IRA. So if your CPA or a friend maybe mentioned a SEP IRA, then a solo 401k can also be a good fit. We had a couple of good questions come in.
Sure.
So someone asked if you have I think this was related to the 5-year rule. If you have a Roth 401k and then you set up a Roth IRA, does the 5-year clock start over? Um, this rule can get quite complicated, so I can't go into every single contingency, but if you've had Roth dollars for a long time, typically you have a lot more flexibility with that. If you've only had Roth dollars for maybe 2 to 3 years, that's where they're pretty heavily restricted. So I hope that helps, John. That's at least the basics of it.
Yeah, I'd also say too that if you're asking that question, it's actually less of the answer is less based on like whether you can take those Roth 401k like distributions out like sooner rather than later. It's just that the idea for individuals who are doing a Roth, they most likely should have a strategy that is actually a term that is pretty extended and long. Like you want that sort of growth to continue for a long time because the more growth you get, the more taxes you're actually avoiding. So, like we're talking here in 5-year time frames, which in the moment sounds like a long time, but for individuals who are able to afford to pay those taxes up front and choose to do that, they typically should have an extended time frame beyond a comparable contribution to a traditional anyway. So, I guess the idea is that you're in a better situation to let that money run for longer, even potentially like exceeding your lifetime. So that's a strategy as well because it's non-taxable money. So as you pass this on to a future generation, for example, it's a from a tax treatment standpoint, you can find tons of articles on sort of like the strategies and what fits best for your personal situation. But usually it's an extended time frame.
Okay.
So 5 years wouldn't even be relevant in most cases.
3 questions in the interest. I'm going to go through them pretty quick because they keep coming. So, all right, John, thank you. He was good on his answer there with the Roth. Someone said, hey, I work and I have a 403B. I do not have a 401k, but I'm not able to roll it over to a self-directed IRA or solo 401k because I'm still working at the same company. They also say they're over 59 and a half. So this is just an important thing to know is if you're working at your current job, it's usually very hard to roll money out of the company and they'll put a lot of restrictions on it. Truth be told, usually to save some costs and hope, they keep people using their retirement vehicle and they don't do something with it. But usually you do not get a chance to move money out until you separate from your employer. There are usually some rules when you get to retirement age at 59 and a half that should make that easier, but you're really going to have to read your fine print. Sometimes, HR doesn't really want to be too helpful or they might not know just because, the more employees that leave the plan, the more costs could rise for the business or the other plan participants. So definitely be your own advocate there and try and read your plan documents. And you can always give us a call. We can help you look over the basics of that.
Yeah. And I was a little broad the first step is that it needs to be a former employer in almost all cases for you to be able to do a rollover out to an IRA. But the types that are eligible to be rolled in are all of these sort of like Section 400 level retirement type plans. So 403Bs are just less common. So for those of you that don't know, it's the sister type of 401k that's available for people who work primarily in the education and maybe like church sector to a lesser degree, but very well known and utilized if you're in the education space. So if you work for a college or a school district, or you're a teacher and so forth. But Brendan's exactly right. Like you typically need to be separated from that employer to be able to roll it over, whether it's a traditional corporate entity sponsoring a 401k or whether it's a state university sponsoring a 403B, for example. And go ahead, Brendan.
Yeah, let's maybe move on to the next one, Henry, for time. Yeah. So we had someone asked, what's the annual reporting requirements for the IRS? And I think this one came up when we had the solo 401k up there, but let's maybe go over the IRA first, and then we can quickly mention the solo 401k.
Okay, so the IRA, you basically report like the year-end value in the form of a tax document, and then the IRS is not very creative, so most of their documents or most of their products are actually just named after the section code. So it's a 5498 form, so real simple in the IRA. The 401k itself, they have a reporting structure, again, not named any actual name, but form 5500, and you are subject to writing to submitting those for a solo 401k plan if the amount is over $250,000 in the overall account. So our solo 401k accounts do tend to be larger. So a large percentage of our solo 401k customers, do need to do the 5500s, which we provide full support for. But underneath that, you don't. That kind of helps. Again, kind of getting into the weeds there. So maybe those are ones that I maybe encourage, like, either doing a little self-research on that and or giving us a call if you want to talk through a little bit more over like, a quick like 5-minute phone call.
Okay, let's keep rolling on slides, Henry, and then I'll bring up questions.
Perfect. Okay. So within the self-directed IRA, our company, we offer two types. So I'm not going to go like too much into detail, because these are the ones that if you're trying to determine which one's right for you of the type of IRAs that can do alternatives, this is specific to alternatives IRAs. So now we're stepping away from the differences between regular IRAs at brokerage houses and your financial advisor versus the ones we offer, which are self-directed or alternatives capable IRAs. So within that subset now, there are two types. Those are checkbook IRA and custodial IRAs. So the direct custody is very similar to the types of IRAs you might have at these brokerage houses or financial advisors. So they're easier to manage if you've never done this before. If you know that you want to open an IRA to do some alternatives, but you might have like limited transactions, like there's a couple of private deals you want to do, and you know that, hey, the money I want to use for that is from an old 401k plan, so I can invest in these private deals, and there's two of them, for example, then the direct custody ones, they're for you. They work best for just passive deals, like when you're just becoming like a limited partner in a deal, you're just making like a dollar amount investment as an angel into a early stage startup type company, or you're just joining and buying a unit inside of a syndicate, for example. So in our case, like you basically go on the site at rocketdollar.com. We have seven pages, 8 clicks, and then the account gets created for you. And then on our side, our custodian provider, which is our sister company, we're the same owners. We have ownership structure in each other. Then they actually will review to make sure that it's an IRS eligible investment, and actually the custodian distributes the money on an IRA that's on your behalf. And what I just explained there is exactly how your IRA accounts at a Fidelity or Charles Schwab or your advisor at Merrill Lynch or Edward Jones is actually set up. So technically, the custodian distributes funds for the benefit of you. So that's how the accounts are titled. Now, getting in here, I go the wrong way. So, it's a little bit skipped one there. But the checkbook control one is when your IRA invests into one entity, which is a trust in our case that we create for you. So let me just explain this. It's easier for me to explain the cons. Let's just say that this is the more advanced self-directed IRA. These are for people that they want faster transaction times. They just don't want our custodian backend to be sort of like the decision maker on whether this investment is eligible to be done in an IRA or not for you. So you don't have to wait for that time. You have high transaction activity. So if you do buy a rental property, although you might think that you're just going to do one transaction, the rental property itself kicks off a lot of transactions. So you're going to have to provide maintenance. You're going to have to pay for contractors. You will hire a property manager, and you're going to collect regular rent checks. So all of those are actually transactions related to one single property purchase. So if you have high transaction activity, it all needs to go through the IRA. That checkbook IRA structure may be relevant for you. And then the graphic on the upper right is just to help you understand that Rocket Dollar still creates an IRA. We have a technology backend that will automatically create this trust that is only controlled by you. And that trust is actually the one that holds your investments. And since it's a trust, it also operates with our integrated bank partner to open the account. And any funds that are IRA or 401k rollover funds that go into it are treated for tax purposes as if it's like an IRA. And then you operate that account to be able to make those investments, i.e. like invest in that property, i.e. like, send out $295 to a contractor to go fix a toilet, for example. On the front end, longer to set up and, just more complex. But again, you can determine what's right for you. But if you're starting out, the direct custody one is a better bet for you, and you're doing limited transactions. If you're pretty advanced in this and you just want to have more control, the checkbook one is the one that we offer. And that's actually how we started the company back in 2018. So we have quite a few of these as well. And it's a real flexible account for those that are really like active private market investors who have a lot of tax advantage dollars to utilize. So again, I kind of mentioned here just now this is going into the asset classes, but I don't know if I want to stop there, Brendan, because any questions there are just going to be pretty advanced for like the whole group. So, maybe we could just ask for a little reprieve from the people that may be in the chat asking specific questions for checkbook versus direct custody that you're more than welcome to actually just have a conversation and schedule like a little 15-minute call. You'll get a lot more of your questions answered than me trying to give a high level answer just to get to the next slide and get through the presentation.
Yeah, so I've been typing furiously. There's been a lot of questions. So
I see that. Yeah, good job.
Yeah, we have 16 already. So I'm just going to keep typing in the chat, and I think you can keep rolling. People can review the answered questions. So if you maybe want to see what other people are asking, you can go into the Q&A, and then the answered questions are visible to everyone.
Right. Okay. Perfect. So I'll just say that, look, with real estate, there's two different ways to invest in real estate. So that's the number one most popular investment with self-directed IRAs. So, maybe just a quick poll question here, and people could just kind of glance at the bullet points. I know these slides are they're designed to be word heavy because, we're happy to sort of like, make these available in a recording of this webinar afterwards. And you can just kind of get to the points so you can read the information that's relevant for you after. But there's active and there's passive investors in real estate. So, really, you don't need to answer this one, but, there's different types of investors even within one asset class like real estate. So, I just wanted to delineate here between what's like active and what's passive. So passive is that I just bought a $50,000 unit into a syndicate platform that's going to buy the next car wash, type business around the corner from me, or a storage unit investment. So that's something that both Brendan and I have done personally. And then active is someone who wants to purchase an individual property, for example, and then procure the services of a property manager and actually be the landlord, but own that investment inside of an IRA. So like, you can kind of determine what's right or wrong for you, because what we have is we have a lot of investors who do real estate outside using taxable accounts, and they've gotten pretty experienced in it. And now they want to tap some of the capital in their old 401k to do two more with a different tax structure inside. So they already have two properties that they own just in taxable ways. And then they want to add two more using retirement accounts because they're an experienced active real estate investor who's comfortable owning properties and working with property managers and contractors and so forth. So what you can't do, so this is actually another important slide, but again, I want people just to glance at this because we can talk about these all day and people are going to ask specific questions, because usually when this slide comes up, people will type in the chat, Brendan. And again, we'll just ask that, hey, we invite you to have a call with us. We have multiple people answering the phone during business hours. But what can you not do? So people always ask that, well, can I turn around and buy the property that I live in currently? The answer would be no. And earlier, there was a little bullet point that said it just needs to be arm's length. So maybe the better rule of thumb in your head to keep in mind is just that for any type of IRA investment that you do, you just need to make sure that you're at an arm's length from it. So it can't be anything that you already own. It can't be anything that you're using for like personal enjoyment. So you can't buy a property using an IRA and then for 2 weeks decide to use it as a vacation home or rent to a disqualified person. We have a detailed chart that looks like, a big, like a giant family like tree. For example, they'll show you like who is or is not a disqualified person. And the idea is that we also highly recommend that just to make sure that you can fully always establish and validate that you're truly arm's length from this property, that you put no sweat equity of your own inside of it. So, you can't gain advantages by saving a few bucks and doing some of the work yourself. You should outsource to a property manager, even if you're someone who owns investment properties and you're used to kind of doing that sweat equity and work on your own. If you're going to turn around and also use IRA accounts with a provider like Rocket Dollar and do these, you should have that property manager in place. So there's no question that you're an arm's length from that, and you're not trying to save a few bucks because you installed the floors yourself. All transactions must flow in. So this is where we talked about where the checkbook one's much more relevant, because you have a lot of transactions that are related to this particular property. At the very least, hopefully you have it fully rented throughout the entire year. You're going to get 12 rent checks, for example, plus a deposit check. All that money movement back and forth needs to flow to and from the IRA account or the associated trust bank account, which is within the IRA. So again, further questions, just kind of contact us. It'd take too long to probably go into those ourselves. And I mentioned here, so family tree, not really pretty pictures. We didn't want to actually use a real family there, but the easiest way to understand this chart is that the people you can't rent to or sell to or do business with in the form of an IRA, they're disqualified people. So the easiest way for me to kind of explain this is people that are like sort of one step up or one step down or one step sideways from you and your family. So, for example, you can't invest in your own property or yourself. You can't invest in your spouse because you guys are side by side. You can't invest in anything or rent a property that you own in an IRA to your parents because they're one step above you, or children because they're one step below you. So just think like that. But the other ones are okay, like siblings, uh, cousins, family, friends, aunts, uncles. So the IRS actually considers that far enough away. And the real premise here, so if no one's ever told you this, you've probably heard these terms, but as far as I can tell in all the meetings I've sat in over the years, the thinking is that the ones on the bottom that are disqualified, you would be likely to give them a break. And if you give them a break, you're getting an economic like value, which is disallowed by the IRS. And I guess the ones above, like let's say, for example, in-laws, you wouldn't give a break to your mother-in-law in the form of rent. So, I don't know anyone else's relationship with the mother-in-law, but if I'm renting a property, they're going to adhere to the terms of the lease, I guess, is the thinking from the IRS if it's mother-in-law, but not so much if it's your, daughter or son, for example. Hopefully that helps. And, maybe here, again, we don't need to answer out loud here, but, there's a lot of people here that maybe are already experienced in real estate alternative investments. So, think to yourself that do you or your spouse or your family work on these houses, or are you someone who actually outsources the management, the leasing, the maintenance and upkeep of a particular property? So just something to think about that. If you answer yes to that, for properties you own in an IRA, you should always consider the outside help instead. It just protects you. Your tax advisor will tell you the same thing, and we will too if you call and ask us on the phone. So now kind of just moving, and I know that was specific to real estate, but we can kind of give you the nuances on the phone of what an alternatives IRA may look like if you're going to do crypto, or if you're going to do all private equity investments, or if you're going to do precious metal investments. But I just wanted to highlight our most popular one here for the sake of like time today, and make sure we have time to answer questions at the end. But the common frustrations we see for just self-directed IRAs in general is that they have higher fees because these are being offered by platforms like ours, where we don't actually present or manage or make any money off of the deals or the investments that you do in the private alternative space. So we are truly an IRA platform and removed. So because of that, we make our money in the form of fees associated with the account creation, upkeep, filing, and reporting requirements that someone mentioned earlier. But in our case versus our competitors, we define that in a flat fee. So it's not based as a percentage of your account value, which is what many competitors do in the space. And then, just slow deal review. So we have a 48 deal review. So even if you're doing the custodial plan, which is probably appropriate for 85 to 90% of people on this call, whether you've done self-directed IRA investing or not, it's still appropriate for 85, 90% of you that we're talking to today, that we have a service level agreement, SLA in business jargon terms of, we do that review through our custodian in 48 business hours. So, and then another one is that for those of the 10% that maybe the checkbook trust IRA is more appropriate, the providers in the space, a lot of our competitors, they kind of just give you a kit and tell you to go find that bank partner. So in our case, we're already integrated and tied to one that just comes automatically with the creation and setup of that account. So everything is kind of tied in together. Everything like talks to each other, and you don't have to worry about trying to go and find your own bank partner after you've set up this IRA. So just adding more complexity. And again, I've mentioned this a number of times, but 1-855 Rocket D has been our phone number since the beginning. We answer the phone. We're available during the day. And a lot of these questions, it's a different type of IRA account. So we're happy to sort of like spread the knowledge. And while you're considering us or the services of one of our competitors, I think our attitude has just been that, we just want to make you aware, want to make you comfortable. And if that's not with us, that's obviously your choice as a consumer in today's digital environment. So.
And we got some poll results in on the real estate, Henry.
Yeah.
So about 2/3 people coming in, and 8 people said they really like to work on real estate properties themselves. 6 said they always hire a professional, and probably the other third says they don't touch any individual real estate.
Okay, yeah, and you know the third that says that they don't touch individual real estate. I mean, one of the reasons may be that you obviously that you're just not comfortable doing it, or you don't want to be a landlord. But I often find that another big reason is because it requires such a large capital outlay. So maybe being able to tap into old 401ks actually eliminates if that's your reason, because you know over the course of a working career and consistent contributions to a 401k people have relatively large amounts to be able to make larger purchases like property. So one of the reasons people don't do real estate investing is because it's expensive, and so forth. So this is our pricing sheet. And Brendan, maybe I'll just actually let you maybe kind of explain like the difference between our like sort of silver and gold tiers. I talked about the account types, but I actually think you might be more qualified than me just to kind of give a quick, like, I don't know, 30-second overview of what we see
Yeah.
here at this Harvey Milk.
So we've had these two price levels for a long time. Just so you know, some people have been asking. The silver moved from 15 a month to 20 a month, and we grandfathered in the old clients. So they're, you know, many people are still sitting at the $15 a month if they signed up with us then. So the silver is our basic level of support. You get phone support. You can schedule a call with us. That right now that gets you a direct custodial IRA. So we've upgraded the custodian capabilities. You will have to get your deal reviewed at with Rocket Dollars custodian, and you will have to submit some paperwork for it. So if you're someone that only does a few investments per year, you know, usually those investments have 2 to 3 weeks to enter them. This could be a good IRA for you. Again, we have no minimum opening deposit. That's a really common question. So you can roll in as much as you like. You can do as many deals as you like, and these fees are flat. It's a big difference, as Henry mentioned. If you do 45 deals, you're paying the same as someone that does 1 or 2 deals, or if you bring in $1 million or, you know, $50,000. The gold is our more expensive offering. You know, if you want to say it's a premium offering. We offer our checkbook IRAs and our solo 401ks at this price level. We also have a dedicated phone support for these products, a phone line, because, you know, checkbook clients do tend to get involved into some more complex investment. So our real estate investors, you know, that are very active are usually here at the gold level. Our people that are doing a lot of different investments are at the gold level. And some people just say, look, I like to call my Schwab person. I have a signed advisor. So they like to match that here at Rocket Dollar and have that gold line support.
Sure.
We have 4 free wire transfers as well with the gold. And our new bank partner, we have potentially 25 free wires if you want to inquire about that. We have some upgrades there as well.
Yeah, we haven't updated that, but we're contractually working with the bank provider that we're connected to up that number to 25 free wire transfers. So again, you know, if you're doing active transactions in the account, the last thing I'll mention before kind of advancing the slide is that on the right-hand side, the gold, I did spend, you know, roughly about 12 to 14% of today's presentation kind of telling as well the difference of possibly a fit for solo 401k as well. So the solo 401k is only available at that gold level. So someone had asked earlier about, like, you know, the reporting requirements. So if you're someone who has a sole proprietor business or an individual business and you have excess income and you want to make larger contributions, again, you can still roll over old 401ks into a solo 401k as well. But then ongoing after that, you can put more money in. Those are available at the gold level because effectively by nature and virtue of the account types, they all come with checkbook control. So think like if you have that checkbook control and you're the more advanced person, you know, we're very competitively priced for people that do that. Everything is sort of web-based as well, but just know that solo 401ks are only on that right-hand side. So for people that may have that question. And again, this is kind of, you know, here. So, and really, you know, for those, just how to get started. So I mentioned earlier, essentially 7 screens, you know, 8 boxes to fill out. It kind of gets you started. And then immediately upon account creation, you could then work with us and we'll help you transfer funds into that account. Because obviously, you know, you pay a sign-up fee for the account. So it just makes sense to kind of get the process rolling to get funds in there as soon as possible. And then we kind of help you take it from there. So you can make transfers from an existing one, which is typically how you get the larger dollar amounts. You could also make a contribution and so forth. So these are just the ways that you can fund your account. It's a web-enabled platform, but it's also a website. Lots of security control. So we're a SOC 2 Type 2 certified company. And then the custodial provider is a state registered entity. And I should probably mention too that our custodian platform and Rocket Dollar combined with with our various companies and IRA products that we have, we roughly custody about $11.5 billion right now for customers in all 50 states. So we've definitely been around, a lot of experience in sort of working with these types of IRA accounts. And then, I promised earlier just to kind of give that number because I've always said that in terms of letters, but people can see it here. So yeah, Brenda, I probably should have just kept saying it's 855-762-5383, but sometimes, they still have the letters, I think, on the digital pads on the phone nowadays.
Thank you for the questions. We still have plenty here, so we can probably start going through some more of those live.
Yeah, and for the sake of time, we'll keep this to like a 50-minute webinar. So why don't we just go through these as quickly as possible? And if we have some left over, again, please contact us.
If a property is owned in a solo 401k, do you have the same requirement for property management like an SDIRA owner property? So you still cannot, the rules are really the same. You cannot work or live in the property or use it as the vacation home. So most people will have at bare minimum a handyman or someone to go in and do repairs in the property. Others will really try and completely, totally separate themselves with a full professional property manager, rent collection, everything like that. We leave it up to the client how separated they want to be. But if someone calls us and says they're just going to violate the IRS ruling, we'll just not open the account for them. So Henry, someone had a question on a minimums. So most people, they'll just bring over how much they want to invest with from Fidelity, Schwab, Vanguard, or their 401k. Others will bring a lot more capital if they're going to be doing some more deals in the immediate future. Just know that if you do not have any cash on hand, you really need to be thinking ahead. If an investment's coming up, let's say in mid-late October, you definitely want to be transferring funds now. So at least 2 weeks lead time. If you leave less than that, you could really put yourself in a tough spot and maybe potentially, put your investment at risk. Can I send money to Rocket Dollar to hold in a Roth IRA until I find an investment? Yes, you can send it to us earlier. Just know that some people, they'll send funds and then they think, hey, I can't find an investment. So we do have a partners page. We are not a financial advisor, but people can look through our partners page if there's something more short term they want to try and invest in, or maybe into another alternative because their deal fell through. We'd love to see people engaged and checking out the space. It's a shame when someone has to kind of close the account if a deal fell through. We obviously would love to keep you as a client. So yes, you can roll funds over. And then we also have partners page. People can review other investment issuers in the space if they don't currently have a deal. So someone asked, I think, we can send a message about this, but someone asked the checkbook account, where does the bank fit in? So for a checkbook IRA, we have a IRA at our custodian. Then there's a trust and then a bank account. Some of our older clients have an IRA, a Colorado LLC, and then a bank account. So the bank account is really the last part of that process. It's really where you deploy your capital out of. And we have a lot of diagrams of this on our website. So just think as the bank partner is where the funds in a checkbook IRA are held, so you can deploy them quickly. With our direct custodial IRA, we do need to do that check for the prohibited investments, and that can take about 48 to 72 hours. We can get it done in 24 hours sometimes if all the paperwork is absolutely perfect the first time. But to be honest, a lot of people need to go find another document after they submit everything. So The bank partner really helps us with the checkbook IRA, enable the client to send funds out a bit faster. And that's more of an advanced topic. You know, you can look in our other webinars or give a call. We can talk through it and look through our website.
It's a really good answer, Brendan. You want to take one more, and then we can let everyone get back to their, I guess, now we're at the midpoint of the week, depending on where you are in the country.
Yeah, so, you know, distributions, you know, really, distributions have to be back in cash in the IRA to be distributed. That's the easiest way to do things. So a traditional IRA, you know, distributes, you're typically required to distribute a certain amount each year once you get to over 72. Roth IRAs, you can distribute stuff really at any time. But as Henry mentioned, it's, you know, you really should talk with a CPA to see, is it a wise time to distribute a Roth IRA, or maybe should I hold on to the funds to have them longer? And we do not offer mutual funds or stocks. And then, you know, a couple of questions. I think this is an advanced one, but you can look at our website. Is so many people ask us about investing into their own startup stock. And we have a long article, complex article on our website about this, but unfortunately, you typically can't do that. A lot of people get excited and think they can, and here's some misinformation on that. So you can definitely read our article on it. Can I invest in the startup I work at or control? And you'll find a lot of good information on there. You can buy other startup stock, pre-IPO stock as well, and that's one of our most popular investment targets that people go after. All right, Henry, I think we're going to close up here.
Sure.
Please email info@rocketdollar. You know, we're checking that email. We can follow up with some of you. A lot of you here use the anonymous attendee, so it will be hard to follow up with some of you that use that. Please email info@rocketdollar or give us a call after the webinar. We'd love to answer your questions.
Yeah, thank you very much, everyone. Enjoy.
All right. Thank you, everyone. Have a great day and great afternoon.